Now we're going to turn towards what's happening with refined products, and where are things going to go as we go through the summer months. So when we look at this overreaction, so we had 2 days of moves up, which took us just above that 2019 average, and that was where we thought we were going to have one big move up, and then we were going to have one big move down, and then that was going to be a bit more of that residual. But instead, because of not so much the severity, because Colonial came back fairly quickly, it was just there was a lot of panic and people ran out and bought as much gasoline as they could. But there's also that inherent problem when we talk about the supply chain, as we always keep highlighting within the Econ show, within this show, which the shortage of truck drivers, again, made that just last longer, the inability of getting it from the rack to the pump, and that created some of this problem. And it carried out not just in gasoline, it was diesel, it was jet fuel. So that's why we had that kind of that second move up, and now we had that correction, and we think that we're going to get much closer to what we have as that average level. So so just to put it into numbers, so 13.331 million was the implied demand. So you can see that big drop, the drop that we haven't seen essentially since the beginning of March. But the average, that 4-week rolling average, is at 14.477. So again, that's why we always talk about the 4-week rolling average. That's kind of the more important gauge as to where we sit. And you can see that there really hasn't been too much change. And that's why we still think that will move up. We'll average that 14.8, 14.9. But again, we're still going to be well off of kind of what is normal when you think about hanging out between that 15.5 and 16.3. So again, that's where we continue to see some of that pressure back and forth, which we think is the market is expecting a little bit more. So now when we start looking at what is being created, how are things being adjusted, this is where we keep talking about that refiners are going to have to pick up their distillate creation in order to increase some of their runs in general, because gasoline, or the light end, is essentially tapped out. And that's why but when you run heavier oil, you're inherently going to have more disty in general, and more of that heavier, not only just resid, but fuel oil and some of the other components at the bottom. Now, a lot of that can be recracked, and again, that's how you're going to get that residual gasoline production, is by taking some of that lighter, the heavier end, and then recracking it to create more gasoline, or trying to do things or increase kerosene and jet fuel in general. This is how refiners are trying to look at the best way to do it, and that's why we had distillate builds across the board. So 14.41 million barrels was put into storage, still 7.1 million below the 5-year average, which is why refiners have space to use. So it's not like they can't do this, and if they did this, they would create a big problem. They do have that spare capacity. It's just, what is the rate of change? So we had that last big cargo finish out. So now Pad 1 imports were down 326,000 barrels a day, still above the 5-year average, but we're starting to see that come out of Pad 1. Now, the problem is we're going to get a little bit more coming into Pad 5, so we're going to see some of those imports remain elevated, but not to the level that we've seen. And Pad 1 still has a decent amount of spare capacity, because when we look at the 5-year average, we're still 10.5 million below that 5-year average. But the rate of change is what's concerning. Now, we don't think this rate of change sticks. We do think that there's a certain amount of flatlining, and we think that it'll just, when we look at that 29-year average, that dotted line, it's just going to move. It's going to move in kind of a smooth upward movement. The question is going to be, is it going to outpace a little bit to the point where we're going to actually have more in storage than expected? And that's why we have to look at what's happening with exports, and are we going to get some of that recracking at some of the heavier ends? But if we do, what is that going to do to the distillate cut? And that's why there's going to be a lot of things to think about and or really consider when we're looking at the different aspects. And when we think about what has happened with production, so the yield on disty was only up about 0.07%. Gasoline was down a little bit, but we did have an increase in runs. So that's why you have to consider, where is it going? And it was going towards the lighter end, as well as the heavier end in general. So then when we look at demand, this is that overshoot to the downside, but just look at what normally happens. It just, because of Colonial, we normally get this reduction. We typically have a big push of diesel ahead of Memorial Day, a big drop, and then we get back to normal. Instead, you can see that everything was kind of shifted to the right. So all of this is seasonally normal. It's just going to be a matter of, where things go. We still think diesel demand is going to remain strong. It's going to bounce above that 5-year average. But this is going to be something to watch. Just obviously, no one's using heating oil right now in any meaningful way, but this is going to be that diesel side as we do have that shortfall. We do have a lot of need for trucking in the market. So then when we look at the trucking side, it still remains elevated. Obviously, it's normalized a bit, but there's nothing to stop it in general. We're going to see rates continue to drift higher just because we do have diesel, we do have labor, all of those costs are going up, and both of those are pure pass-throughs. So that's going to keep those rates moving up, and we've already seen FedEx adjust it. We've already started to see, if you get deliveries, I guarantee you there's diesel surcharges baked in. And that's when we look at just the demand index, we're going to remain at that 185, 200 level, just right in general, just as it goes sideways. Now, we really won't see the spike up just because it's really as high as it can go, but we will see this remain elevated in general just because we do need that trucking. But we are seeing that pickup in rail as well, and that's going to continue to be a big driver because this is the easiest way to kind of move a lot of this capacity through the system and ease of moving things through. So that's where when we look at intermodal is going to remain healthy. When we look at grains and forest products, again, that's going to continue to move. The WASDE came out, it was bullish end stocks in the U.S. I should say bullish pricing in the U.S., bullish pricing globally, which is just going to get farmers, again, driving them to increase yield, moving some of that product down. And then we'll talk about it in tomorrow's FSC show. But there was a big storm. It did impact some of the crops in general. Small, it was 4% here, 1% there. But given the tightness in the grain market and the inflation already in grain pricing, that is not exactly a good situation. But from a rail perspective, we're going to see more cargoes. We're going to see more intermodal. So again, rail is going to continue to be that driver. And here's where we continue to see this overhang. So when we look at, every time we look later on, so this is broken into those different weeks. And when you look at the end of June, it always starts a little bit slower. And then by the time it gets to essentially the current week, it's either at or above the previous week because we're unable to get ahead of this supply chain in terms of kind of fixing it, where things are. And when we look down the supply chain, when we look at what's happening in terms of pricing, in terms of cost, this is why we keep talking about how we are going to keep importing inflation in general, as this is the entry point, if you will, into the U.S. Now, on the other side, for those that have been on the East Coast, the heat wave has ended. 95 degrees is going to go sideways. We're going to get a little bit cooler, but again, much closer to normal. But you can see that massive heat wave that's coming through essentially everything from the Mississippi west. The biggest concern right now is how is that going to impact the crops in general, because you can see a lot of that is over some of the breadbasket states. And it's in a very precarious component because the root system, as they start to emerge, you want them to create a root system. You want the root system to get deeper so that it can pull a little bit more of its own water versus relying too much on the sprinklers. And this is where we're going to have to look at, is this going to burn out some of the roots? Is this going to create some of those issues? But again, these are going to be things to watch. This is more for what is going to look like when we think about inflation and the cost to the consumer and really the ability to go out and spend. So now when we look at gasoline, here you can see that as we were saying in general, gasoline was just going to go sideways, and now we had that break to the upside, getting closer to where we were prior to that essentially the Texas freeze-off. And this is where the comps continue to get harder. So when we look at gasoline, we had a little over 7 million barrel build, putting us very close to that 5-year average. And as we said in segment 1, blending components is now above the 5-year average by that 1.3 million at 5.71 million. And this is where when we look at kind of what happens, we normally get a build after Memorial Day. And that's why you push the product through to prepare for Memorial Day. Then you refill after that. And then you start to see those draws that accelerate from, let's say, the end of June into really the last hurrah of Labor Day weekend. So this is where instead we're seeing these counter-seasonal builds, or at least not draws. And that's where there's this expectation of driving. And there's more than enough global product to meet it. And now refiners are trying to get ahead of it and continue to meet that rising demand, or at least try to capture some of that crack spread, which has weakened a bit. And when you look at imports remain elevated. We were up 118,000 barrels a day, over 1 million, bringing us above the 5-year by 342,000. And that's where we're going to continue to see an elevated level. It's going to come down a bit. We based on where things are right now and how some of these assets are moving, we'll fall back below 1 million barrels a day of imports, but we're still going to maintain this 860 to 900, just given what's behind it. And again, that's going to keep putting pressure. And as refiners ramp up and we have imports and we have demand that is really good on the weekends, kind of underwhelming on the weekdays, that's going to keep us, again, in this kind of flatline level where we're not really going to work through any of this excess capacity. And this is where, when we look at gasoline demand in general, here you can see that we did have another nice little high, but there's also some of that residual of how many people were still filling up, how much of that came through. And it was only across 5 states. It was only less than 20% in that 5. So the answer is not that much. This is still a good number. This is still a bullish backdrop. But our comment is that now we're going to flatline. Now we're not really going to go up that much. We're not going to go down that much. It's just we're going to sit sideways. We will have graduation. We will have some of that additional drive. But again, we always have that. Nothing is new in terms of seasonal, which is why we're really unable to close that gap. And then when you look at demand for Monday, just looking at kind of where things are, demand fell 2.7% from Memorial Day, but was up 0.9% from the average of the last 4 Mondays. But you can see that we had that weird Monday that was mixed in. So we're pretty much right kind of where we should be, or where we think we're going to stay as we go forward, just because, again, the weekdays will start to calm down a bit. Weekends will continue to be robust, and that's going to be that friction point. And this is the biggest driver right now, because right now, this is looking as of June 7th, and we're already actually closer to about $3.05, depending on where you are, which that's where we think it kind of stops. We don't think it goes too much above $3.05. Like, if I had to say, Mark, Labor Day, where are we? I would say probably close to $3.05. The one that remains concerning is the diesel side. So diesel's already at $3.27 and I thought it was going to stay around 327, but just based on the demand, based on there's a clear drive to 330. Now, that's another benefit of what refiners are looking at. They're like, all right, well, gasoline is still nice. We're coming to driving season, but diesel demand is healthy and it's strong, and there's a lot of pricing in there, and people seem to be taking this down, which is where you're going to get that pivot. And they'll start to increase the diesel runs, which again will keep this fairly capped, but we could get to about $3.30 before we, I think, pull back to about that $3.27, 28 cents in general. Now, when we look at that blending components, here's that counter seasonal build coming back up, and this is what we've been talking about when we look at some of that activity, what has happened in general. And now we're going to get this kind of rally back up as we continue to see some of this movement. And this is, I think, more concerning because it's speaking to how many imports we can pull in, where are they trying to target? And as this becomes this, trying to capture that margin, this is going to be one to watch, to look at what is that underlying really baseline demand that we're seeing. So this is one of those, canaries that we want to look at. Now, obviously, we had that big drop. It's the lowest that we've had, but it's artificial. This is not a real drop. Just like that spike up wasn't a real spike. So you have to be realistic. What normally happens, and when you look at the last 15 years, again, there's normally a spike and drop. Like that normally happens around Memorial Day. It was just exasperated on both sides because of Colonial, which is why as we come into some of this normalcy, we think it'll just continue to trend along the seasonal lines, but again, still moving into its just kind of inherent backdrop. And when we think about the backdrop in general, that's where we think it's going to remain at that 8.9, 9 million at this point. It's probably a little bit better than we were initially talking about with about 8.8, but still, again, well off kind of where we should be at this time of year. You can see it's always lumpy, which is why we always talk about the 4-week rolling average to understand kind of where this backdrop is. And this is when we look backwards. So when you could see those, we had the one big jump, which was Colonial. We expected it to kind of drop back down. Instead, it went up one more time because of that severity. And then we had that really big drop, which is kind of what we were saying, where instead of having one big drop, now we'll have two lower prints than what we should as we continue to get some of this normalcy. So we think that we'll shake out at about 8.9. Next week, we could come in about 8.7, 8.8, but it really, that's where we think that we're going to live over the next, 2 or 3 weeks. And then when we look at propane, we had a big build of 5.5 million, but we're still 7.2 million off the 5-year average. But this is what we were expecting, where we do have activity picking up in the U.S. We do have more fracking. We do have that accelerating, which again, as exports, still remain strong, demand is going to dwindle a bit. But this is what normally happens. Again, we're still kind of moving along what we've been talking about with that 2017 normal in general. So then when we look at activity, this is the component that we were highlighting. So workplace was down. Obviously, Memorial Day is picked up in that 7-day, that 7-day average. But parks have already pushed up, and that's where people staying local, doing more. We still have more residential, people working from home, not going into the office. And this is kind of highlighting how things are just here. We're not really seeing, obviously, parks are the big component, which is why we have, summer driving. People do more. They go out. They have to drive there or walk there. So again, there's going to be more activity. It's just there's really nothing saying that there's a big trend in any direction. And the fact that workplace remains where it is just highlighting that weekday softness. And that's where we keep talking about what is the weekday versus weekend, and we're seeing that really come through the system. Then on the higher end, because if you think about people who own Apple products, it's only 20% of the market in general when we look around the world, but it gives you an idea of, well, what is that 1%, or I should say the 10-20% of the populace. And it had a nice little spike, and now we're starting to see some of that flat line, some of that activity. There's, again, that friction point back and forth where there's still some restrictions. Some of it has been lifted. So there will be more upside, but it's going to be a little capped, again, as people digest getting back to normal. As I was I had to give a presentation in Florida, and we were in Orlando, Disney Springs. So I'm walking around, and it's, me being the obnoxious person, I was talking to different waiters and people working, and I'm like, so, if you had to put a figure on it, where are you in terms of normal? And it was a very consistent 75%. We're 75% of normal. And I was like, well, are there any restrictions? And they're like, no, no restrictions. And when I was walking around, you could walk around without a mask on, but if you went into a store, you had to have a mask on. So there's still those restrictions. There's no restriction for how many people, or at least it felt like there was no restriction for who could be in those stores. But again, that's kind of like people are starting to feel it out. And when we were flying, the plane was packed, but there were 3 less flights. So that's what we keep talking about, is they're trying to maximize the amount of people on one flight without having to bring back the excess. Again, trying to capture some of that margin that they've missed over the last year and a half. And now when we look at vaccines administered, you can see that Europe continues to accelerate, which is a positive. China, India as well. So India's gotten better, still on the low end, but again, in the right direction at least. And now the U.S. has been talking about buying 500 million doses of Pfizer and then donating it, again, trying to push it out, trying to accelerate that vaccine level. But another better way to, I think, look at it is the percentage of people vaccinated. And this is where when we look at, okay, well, how many people are vaccinated? When you look at Italy, Germany, about 24, over 20%, the US at about 42%. The problem is you get this surge and then you kind of tail off a bit just because people just maybe don't want to, they don't have time, it's a wait and see. So that's why you get to a point and then you see kind of a pretty steep drop off. And that's where we have to look at. Now, India is the one that's the most concerning when you think about some of that normalcy coming back, because only 3.3% of their populace is actually fully vaccinated. 11% has at least one dose, which again, they're looking to accelerate that and they've already made purchases to do so. But that's going to be some of that normalcy in Asia. The problem when we look at this chart is, well, what is happening in Asia? And there still continues to be a very slow rollout, which is why you're seeing that, just COVID in general remain a problem there. Now, when we look at jet fuel, here's that big drop that we were initially expecting earlier, but it just came a bit later, where now you're going to see, but again, it's always important. Look at the seasonal. We normally have that drop. It was just exacerbated to the downside because of those shifts. And now we're going to start to see that movement back up. And we'll stay at that kind of confidence range here at about that 1.3 million. So just because there is more activity, it is the summer, so you do have more happening. But we did have a build of 1.68 million, which puts us 2 million over the 5-year average. And it's really because we started creating more, in terms of yield and keeping more of it from the disty pool. It's just there's the demand, again, remains lackluster in general when we think about what the normalcy looks like. So when we look at activity here, you can see that, North America, or the Americas in general, starting to get back, almost back to normal. But when we look at Asia Pacific, when we look at some of these others, you're starting to see a little bit of a rollover. Europe's obviously getting much better. Rest of the world is starting to get up there. But so the average number of departures per day increased 955 week on week. Very much a positive in terms of that short-term look. But remember, we're in summer. We're supposed to see an increase in flights. So globally, now we have to look global to think about how is this going to impact everything. The passenger flight schedule for the 11 weeks ahead. So now we're looking into really, where are we going to be post-summer? So 11 weeks ahead declined by around 2.4% since last week. APAC slashed the June schedule by 4.6% since last week. EMEA cut flights by 5.7%. This comes on top of deep cuts of a similar level last week. The Americas remains fairly stable. So that's where we can, it's just you're getting that summer spike, and then where are we post-summer? And that's where there's just that conflict in terms of, well, how sticky is this? Are we going to continue to see this roll? Now, it could change. There's time to do it, but companies or at least airlines aren't in any rush to bring back some of that additional cost unless they're comfortable with where some of these passengers are going to be. And this is, as we've been talking about, we're moving up along that seasonal norm as you see that we typically have that peak to trough. Trough to peak in terms of where it normally goes, and we're following the trend. It's just at that reduced rate in general, just because again that hesitancy to get on a flight, which after being on a flight with wearing a mask for hours upon hours, I have a newfound respect for children that have to do that in school, because it was terrible and it would have distracted me and it would have made it very hard for me to pay attention. Now, when we look at OpenTable, we continue to say the same thing, where the weekends will outperform, be 3, 5, 7% above normal. And then the weekdays, about 15% below normal. And that's where we continue to kind of see some of this back and forth. And it just shows some of the activity. But one of the hindrances, or something that we continue to see, is just the cost of food and the cost of just going out is continuing to increase, where restaurants are continuing to raise prices, trying to pass through some of that cost on the labor side, on the food side. So those are going to be things to balance out kind of as we go forward. Now, in the next segment, we're going to go abroad a bit and look at some of the different moving pieces as we see some demand coming back in Asia, but we want to look at, what does that look like in general, and how is that going to drive the market, the underlying crude market.